The global financial system is built on one fragile idea: trust. Not trust between people, but trust between institutions, central banks, governments, markets, and currencies. At the very center of this system sits the United States Federal Reserve, an institution so powerful that a single sentence from its chair can move trillions of dollars across the world in seconds. For decades, the Fed has operated behind a wall of perceived independence. It's insulated from politics, elections, and public pressure. But what happens if that wall cracks? What happens if a former U.S. President, Donald Trump, forces open the doors and launches a probe into the Federal Reserve itself? This is not just another Washington scandal. This is not about partisan politics or campaign drama. If a Fed probe led by Trump gains real traction, it could trigger a chain reaction powerful enough to destabilize the global financial system in ways we have never seen before. To understand why, you first have to understand what the Federal Reserve really is and why its independence. This matters more than almost any other institution on Earth. The Federal Reserve controls the world's most important currency, the U.S. dollar. The dollar is not just America's money. It is the backbone of global trade, global debt, global energy markets, and global reserves. Oil is priced in dollars. International loans are issued in dollars. Developing nations hold dollars to stabilize their economies. Even countries that openly oppose the United States still rely on the dollar-based system to survive. And the Fed controls the supply, cost, and direction of that dollar. Interest rates, bond buying programs, emergency liquidity tools, these are not abstract economic concepts. They determine whether countries fall into debt crises, whether banks survive crashes, and whether markets soar or collapse. That is why the Fed's independence has always been treated as sacred. The moment markets believe the Fed is no longer neutral, the entire system begins to wobble. Donald Trump has been attacking the Federal Reserve for years. During his presidency, he openly criticized Fed Chair Jerome Powell, accused the Fed of sabotaging economic growth, and claimed interest rate hikes were politically motivated. At the time, these attacks were dismissed as rhetorical pressure. The system held. Markets shrugged it off. But a probe is different. A probe is not criticism, it is confrontation. It implies investigations, subpoenas, public hearings, and political scrutiny of decisions that were previously treated as technical and neutral. The moment a Fed probe becomes real. The message to the world is simple and terrifying. The U.S. Central Bank is no longer untouchable. Markets do not wait for outcomes. They react to signals. If Trump or any political force successfully reframes the Fed as a political actor rather than an independent institution, global investors will start asking dangerous questions. Are interest rates being set for economic stability or for electoral advantage? Are monetary decisions still based on data or on pressure from power? Once those questions enter the system, trust begins to leak out. And when trust leaks, money moves. The first cracks would appear in U.S. Treasury markets. These bonds are considered the safest asset in the world, not because the U.S. is perfect, but because its institutions are stable. If the Fed's credibility is damaged, investors may demand higher yields to compensate for political risk. Higher yields mean higher borrowing costs for the U.S. government, which already carries historic levels of debt. That alone would be destabilizing, but it doesn't stop there. A loss of confidence in U.S. debt would ripple outward. Banks, pension funds, and sovereign wealth funds across the globe hold trillions in U.S. treasuries. Even a small reallocation away from U.S. assets could trigger massive volatility. Currency markets would swing. Emerging economies would feel the shock first. As capital flows reverse and local currencies weaken, ironically, the very dominance of the dollar makes the system more fragile, not less. If investors begin to believe the Fed is politically compromised, they may accelerate efforts to diversify away from the dollar. This trend has already begun quietly, with some countries increasing gold reserves or experimenting with alternative payment systems. Fed probe could act as an accelerant, turning slow diversification into rapid fragmentation. And fragmentation is the enemy of stability. The global system works because everyone plays by the same monetary rules. Once those rules are questioned, coordination breaks down. Central banks start hedging against each other. Financial alliances weaken. Economic blocks turn inward. The result is not immediate collapse, but long-term erosion. Trump supporters may argue that a Fed probe is necessary transparency, that no institution should be above scrutiny. And in theory, that argument has merit. But global finance does not operate on theory. It operates on perception. The perception that the Fed is independent is as important as independence itself. If that perception is destroyed, rebuilding it could take decades if it can be rebuilt at all. The most dangerous part of this scenario is that it may not look dramatic at first. There may be no single crash day. Instead, the system would bleed slowly. Higher volatility, weaker currencies, nervous markets, and rising geopolitical financial tensions. Each shock would feel manageable on its own. Together, they would quietly rewrite the rules of global finance. And this is only the beginning of the story. Because once the Federal Reserve is politicized, the question is no longer whether the system changes, but how far the damage spreads. Once the Federal Reserve loses its aura of independence, the shockwaves will not stay confined to Washington. They will spread instantly across the globe. Financial markets are hyper-connected. Every decision in the U.S. sends ripples that are magnified tenfold in other economies. The minute a Fed probe led by Trump becomes public, the first victims will be global investors who have long treated the Fed as a reliable anchor. Suddenly, that anchor begins to shake. Treasury yields, the backbone of global finance, would spike almost immediately. Investors demand higher returns for the added political risk. When yields rise, borrowing costs for corporations and governments climb as well. Companies that have borrowed billions in US dollars particularly. Multinational corporations and emerging market firms would suddenly face repayment obligations they cannot afford. Some would default. Others would slash spending, lay off workers, and delay expansion plans. A slow-motion economic contraction would begin, invisible to many until the first quarterly earnings report triggers alarm bells. Foreign exchange markets would also react violently. The US dollar, which has served as the world's reserve currency for decades, relies almost entirely on confidence. Even a hint that the Fed's decisions are being swayed by politics can trigger a sell-off. Investors would flee to safe haven assets such as gold, Swiss francs, and possibly cryptocurrencies. The sudden outflow from dollars would destabilize countries that rely heavily on dollar-denominated debt. Emerging economies in Latin America, Africa, and Asia would be hit first. As their central banks scramble to maintain liquidity and stabilize local currencies, some nations could even face debt crises overnight. Global stock markets would feel the tremors next. Equity investors operate on expectations of stability. They assume central banks will act as backstops in times of crisis. But a politicized Fed introduces uncertainty into every forecast. Analysts and traders would be forced to reevaluate their models entirely. Tech giants, banks, and manufacturing firms with global supply chains could see valuations plummet, not because of poor performance, but because the perceived reliability of global monetary institutions has been eroded. Panic selling could cascade through markets, amplifying losses and increasing volatility. Bond markets outside the U.S. would not be immune. Many nations hold large amounts of U.S. treasuries as a core part of their reserves. If confidence in those treasuries erodes, foreign governments may sell off significant portions to protect their own economies. This reserve flight could force U.S. interest rates even higher, deepening the global feedback loop. Countries like China and Japan, which hold trillions in U.S. debt, would be forced to act carefully. A misstep could trigger domestic market chaos or political unrest. Commodity markets would also experience unprecedented instability. Oil, priced in U.S. dollars, is particularly sensitive to dollar fluctuations. If the Fed's independence is questioned, the dollar may weaken, forcing oil exporters to adjust prices or hedge against currency risk. Energy markets, already volatile due to geopolitical tensions, could spike unpredictably. Food prices tied closely to energy and shipping costs would follow, putting additional pressure on vulnerable populations worldwide. The result is a cascading economic stress that extends far beyond Wall Street. Currency diversification efforts, already underway in some regions, would accelerate. Nations that have long relied on the dollar may suddenly push harder for alternatives: euro, yuan, digital currencies, or even gold-backed mechanisms. While diversification can be a long-term strategy for stability, rapid shifts can create short-term chaos. International trade could slow as currency mismatches and hedging costs rise, further reducing global economic growth. The effects would not stop at markets. They would hit governments directly. Higher borrowing costs mean higher budgetary strain. Social programs, infrastructure investments, and defense spending could all face cuts. Politically, leaders would be forced into difficult decisions, either tighten the belt in unpopular ways or risk financial instability. Social unrest could spike in nations already struggling with inequality or political tension. A Fed probe, though domestic in origin, would suddenly have a tangible effect on millions of lives globally. Banks themselves, the arteries of the global financial system, would face severe stress. Banks operate on trust and liquidity. If the Fed is perceived as politically compromised, lending rates could rise unexpectedly. Interbank lending may tighten, and some institutions could even fail. Global banking networks are deeply interconnected. The collapse of one major bank can trigger a chain reaction across continents. This is reminiscent of the 2008 financial crisis, but with a new variable: political interference at the core of the central banking system. Insurance markets and pension funds would also feel the pressure. Pension funds rely on stable returns from bonds and other fixed-income instruments. If U.S. Treasuries lose credibility, the portfolios of millions of retirees worldwide could face shortfalls. Insurance companies, heavily invested in global bonds, could see liabilities rise dramatically. The impact is systemic. Governments, businesses, and individuals all depend on the Fed's decisions remaining credible. A probe threatens that credibility directly. Geopolitical tensions would inevitably rise as nations scramble to secure their economic positions. Countries may adopt protectionist policies to safeguard their markets. Trade alliances could fray as trust between partners erodes. Strategic competition would intensify, particularly among major powers like the U.S., China, and the European Union. A single domestic probe could catalyze a broader geopolitical realignment. With nations hedging against perceived instability in the U.S. financial system, and then there is psychology, the least predictable yet most dangerous element. Markets are as much about perception as reality. Fear can be contagious. Once investors believe that central banking has been compromised, panic can escalate far faster than any technical economic deterioration. Even if the Fed retains operational competence, the narrative of political interference may be enough to spark selling, capital flight, and speculative attacks on currencies and assets worldwide. The domino effect would be almost immediate. Volatility spikes in equities, bonds, and commodities. Capital flows reverse. Emerging economies face debt crises. Currencies weaken. Governments tighten fiscal policies. Banks tighten credit. Social unrest increases. And geopolitical tensions rise. All of these effects feed back into one another, creating a self-reinforcing cycle of instability. It is important to note that this scenario would not require the Fed to fail outright. The perception of compromised independence is enough to ignite a crisis. The global financial system is built on confidence, and confidence is fragile. Just as the collapse of Lehman Brothers in 2008 triggered worldwide panic, a political probe into the Fed could produce similar, if not more prolonged uncertainty for global investors, corporations, and policymakers. The message is chilling. The era of unquestioned trust in the Fed may be ending. The very institution designed to stabilize the global economy could become the epicenter of instability. And the longer the uncertainty persists, the greater the risk of long-term structural damage. In essence, a Fed probe led by Trump is not just a U.S. political story. It is a potential catalyst for a financial earthquake, one that could topple assumptions, rewrite global economic rules, test the resilience of every economy connected to the dollar. Every ripple from Washington would be felt in Tokyo, London, Beijing, and beyond. The world's financial architecture, which has relied on decades of predictable policies, could find itself suddenly adrift in a storm of uncertainty. And yet this storm may be only beginning. Part 1 outlined the seeds of destruction. Part 2 reveals how those seeds could sprout into a full-scale global crisis, touching everything from stock markets to social stability, and from emerging economies to global trade networks. The coming chapters will delve deeper into the political, technological, and human factors that could amplify this crisis. showing just how far-reaching the consequences of a Fed probe could be: political chaos, technology, and the human factor. The global financial system is already fragile, but money alone does not operate in a vacuum. Behind every bond, currency, and stock is human behavior, political calculation, and technological infrastructure. A Fed probe led by Donald Trump would not only destabilize markets, it would ignite a cascade of political chaos and exploit vulnerabilities in the modern financial system that are invisible until a crisis hits. First, consider the political dimension. Central banks have always relied on a quiet balance between politics and economics. Their power comes not just from expertise, but from perceived neutrality. When that neutrality is threatened, governments around the world must adjust. Allies of the United States may suddenly question policy advice or economic forecasts. Nations that have long depended on U.S. monetary stability to manage their own fiscal policies would be forced to reconsider every decision made over the last decade. Trade agreements, debt negotiations, and foreign aid programs could be renegotiated or stalled entirely. Domestically, the political fallout would be immediate and explosive. Congressional hearings, media scrutiny, and partisan commentary would dominate headlines. Trump's probe would not just examine past Fed decisions, it could challenge ongoing policy, creating uncertainty in real time. This would paralyze lawmakers who rely on stable economic conditions to make decisions, slowing legislation, delaying infrastructure projects, and potentially exacerbating unemployment or inflation. Markets react to policy paralysis, and uncertainty about the next steps would send traders into defensive positions. This combination of political friction and market sensitivity is the perfect recipe for volatility. Technology adds a layer of complexity and risk that is unique to the 21st century. Modern financial systems are built on algorithms, high-speed trading, and automated risk assessments. Hedge funds and banks use models that assume central banks operate predictably. A sudden political probe introduces a variable the models cannot compute. Algorithms could misinterpret subtle market movements as systemic risk, triggering automated sell-offs in stocks, bonds, or currencies. In milliseconds, billions of dollars could be moved, creating flash crashes that compound human panic. Even the most sophisticated financial institutions cannot fully account for uncertainty of this magnitude. Furthermore, technology connects every market. Crypto markets, often touted as independent of government control, are not immune. Many crypto assets are priced relative to the US dollar, and exchanges are heavily influenced by global market sentiment. If investors lose confidence in the Fed, crypto markets could experience dramatic swings as traders scramble to hedge against both traditional and digital asset risks. This could ironically lead to a temporary flight back into traditional safe haven assets like gold, further destabilizing digital assets. The human factor, however, may be the most underestimated danger. Markets are ultimately driven by psychology. Fear, uncertainty, and doubt spread faster than capital flows. If a Fed probe becomes a headline story, the perception of instability alone could trigger mass behavioral changes. Institutional investors may withdraw from risky positions. Ordinary investors may panic, and even central banks could respond preemptively to protect their economies. The result is a self-reinforcing feedback loop. Fear drives action, action drives volatility, and volatility fuels further fear. The interconnectedness of global finance amplifies every decision. Consider the chain reaction in emerging markets. These economies often rely heavily on external capital and dollar-denominated debt. Even a small sell-off in U.S. Treasuries can cause massive local currency depreciation. Corporations with foreign debt obligations may default, triggering layoffs and social unrest. Governments may be forced to tighten monetary policy, slowing growth even further. The impact is not isolated, it spreads across borders, creating a wave of economic stress that feeds back into developed markets. Geopolitics, too, becomes a volatile factor. Rival powers could seize the opportunity to reshape global alliances. Nations dissatisfied with the United States' leadership in finance may accelerate initiatives to bypass the dollar. Some may strengthen regional trade networks, issue alternative currencies, or build parallel payment systems. While these strategies may ultimately aim for stability, The transition period could be chaotic, marked by capital flight, trade disruptions, and diplomatic tensions. A single probe into the Fed could thus trigger shifts in global power far beyond the realm of economics. One often overlooked aspect is social impact. Financial instability is not an abstract concept, it affects real people. Inflation, unemployment, and currency depreciation can quickly translate into hardship. Citizens may face higher prices for food, energy, and healthcare. Social unrest could flare in regions already under pressure. Governments might be forced to impose austerity or emergency measures, potentially sparking protests or political instability. Economic crises have a history of fueling social upheaval. And the Fed's politicization could be the spark that ignites public frustration on a global scale. Another hidden risk lies in corporate behavior. Multinational corporations depend on predictable interest rates, currency, stability, and trade flows. A Fed probe would create uncertainty in all three areas. Corporations may delay investments, relocate operations, or hedge excessively against risk. This defensive posture could slow global economic growth, reduce employment, and suppress innovation. In the long term, productivity declines could be as damaging as immediate financial losses. Reshaping economic hierarchies across continents, financial institutions themselves are vulnerable to systemic stress. Banks operate on confidence that borrowers can repay loans, that counterparties will honor obligations, and that central banks can stabilize markets when necessary. Politicized Fed threatens all three. Interbank lending could tighten, liquidity could dry up in critical markets, financial contagion could spread across borders. The 2008 financial crisis provides a template. What began with one institution in one country can cascade globally. But this time, the catalyst is not an insolvent bank, it is the potential undermining of the very institution designed to prevent such collapses. Insurance markets and pension funds, long thought to be conservative pillars, are also at risk. Pension plans depend on stable returns from bonds, which could be disrupted by Fed scrutiny. Insurance companies rely on interest income from fixed income assets to cover liabilities. A politicized Fed increases uncertainty in these returns, forcing institutions to adjust strategies, raise premiums, or even cut benefits. The result is a subtle but widespread strain on household finances, affecting ordinary people far removed from Wall Street. Finally, there is the psychological toll on global leaders and policymakers. Central bankers rely on credibility and predictability to guide expectations. The Fed under political investigation undermines that credibility. Leaders in other nations may hesitate to act, fearing market reactions or public backlash. Policy coordination, which is vital in a globally interconnected economy, could break down at the moment it is most needed. Miscommunication, misjudgment, and hesitation could magnify financial shocks, turning a manageable crisis into a multi-layered disaster. In short, Part 3 reveals that the consequences of a Fed probe are not just financial, they are human, political, technological, and psychological. Markets may wobble, but the deeper threat lies in the unpredictable interactions between these layers. The initial economic shock is only the beginning, subsequent chain reaction through political instability. Technological vulnerability, social unrest, and corporate conservatism could reshape the global landscape in ways few have imagined. The world may appear calm on the surface, but under the veneer, a storm is gathering. The probe does not just threaten balance sheets. It threatens the assumptions that have held the global financial system together for decades. And as the system destabilizes, every decision, every market reaction, and every human choice feeds into a feedback loop that magnifies the initial disturbance. The ultimate question becomes, can any institution withstand such a multi-layered crisis? Or will the global system, so dependent on trust and predictability, finally face a collapse of confidence unlike anything in modern history? The final reckoning: can the global system survive? As the storm unleashed by a Fed probe intensifies, the world enters uncharted territory. By now, markets have reacted violently. Investors have fled risky assets. Emerging economies are under severe pressure. And even developed nations face rising borrowing costs and political turmoil. Yet, the final chapter of this crisis is not just about numbers or policies. It is about decisions, adaptability, and the survival of global institutions in a world where trust has been shattered. The first domino in the final reckoning is financial confidence itself. Confidence is the lifeblood of the global economy, and without it, the machinery of trade, investment, and lending slows to a crawl. The Federal Reserve, once the gold standard of stability, is now under scrutiny. And every major financial actor from pension funds in Europe to central banks in Asia faces a dilemma: continue trusting the Fed or hedge against uncertainty. Hedging often involves selling treasuries, diversifying into other currencies, or hoarding safe assets like gold. Each move, rational in isolation, contributes to systemic instability. In effect, the global financial system begins to self-implode, not because institutions fail, but because collective behavior amplifies fear. The second factor is political polarization, both within the United States and internationally. Domestically, the probe divides not only parties but also the very foundation of economic governance. Lawmakers may block fiscal measures that are necessary to stabilize markets, while partisan media amplifies every misstep. Internationally, allies and rivals alike reassess their relationships with the U.S. allies, may hedge against U.S. instability by accelerating trade deals or currency alternatives. While rivals could exploit the crisis to gain strategic leverage, the result is a fragmented geopolitical landscape, where coordination on issues like trade, debt relief, or economic stimulus becomes almost impossible. Corporate behavior compounds the crisis. Global companies, faced with volatile interest rates and unpredictable currency fluctuations, adopt risk-averse strategies. Expansion plans are postponed, mergers are delayed, and hiring slows dramatically. Supply chains already vulnerable from previous global disruptions experience stress as companies attempt to mitigate currency and commodity risks. Industries reliant on international trade, electronics, automotive, energy face delays, and rising costs. Even multinational corporations with diversified operations find themselves navigating a financial terrain that is increasingly treacherous. Technological vulnerabilities magnify the chaos. High-frequency trading algorithms designed to exploit predictable market patterns can misfire when central bank actions become unpredictable. Automated systems could trigger sudden market moves, causing flash crashes in equities, bonds, or commodities. Even blockchain and digital currencies, often considered insulated from traditional financial systems, react to the dollar's instability and investor sentiment. The combination of human panic and technological speed creates a feedback loop that magnifies volatility at a pace no regulator can fully control. The human factor remains a wild card. Panic spreads faster than information. As fear grows, people and institutions overreact. Governments may impose emergency capital controls to prevent currency collapses. Corporations may withdraw investments from unstable markets. Social unrest increases, particularly in countries where inflation erodes purchasing power. Each reaction, rational to the actor, adds fuel to the global fire, making stabilization exponentially more difficult. Yet amidst the chaos, there are signs of adaptation. Central banks outside the U.S. may strengthen cooperation with one another, creating alternative liquidity facilities or swap lines to prevent complete market freezes. Nations with significant reserves can intervene to stabilize their currencies or shore up banking systems. Corporations can hedge risk using diversified strategies. Digital tools or long-term contracts to mitigate immediate losses. While these measures cannot fully prevent damage, they illustrate the resilience built into the global system, resilience that may allow humanity to survive even a profound shock. However, recovery would be slow, uneven, and painful. Emerging economies would likely suffer the most, as capital flight and currency depreciation create long-term economic scarring. Developed economies may avoid collapse, but would face higher borrowing costs, market volatility, and reduced investment growth. The era of predictable monetary policy, long relied upon for economic planning and stability, could be permanently altered. Global financial architecture may need to be redesigned from the ground up to prevent similar crises in the future. One of the most profound consequences is psychological. Markets, governments, and individuals may permanently question central banking independence, particularly in politically charged environments. The Fed, even if stabilized later, could never fully regain the unquestioned trust it once enjoyed. Global institutions built on decades of stability may face ongoing skepticism, making every future economic shock more severe and difficult to manage. In essence, even a single probe could leave a permanent mark on how the world perceives and operates within the financial system. In this scenario, the lesson is clear. The stability of global finance is not guaranteed. Institutions like the Federal Reserve are powerful, but their power is fragile, resting as much on perception and trust as on actual policy. When politics intrudes into areas designed to be neutral, the entire system becomes vulnerable, exposing weaknesses that no individual reform can instantly fix. The Fed probe may not result in immediate collapse, but it can initiate a slow, creeping crisis with consequences lasting decades. As the dust settles, the question remains: can humanity adapt to a world where financial stability can no longer be taken for granted? The answer lies in reform, international cooperation, and a careful balancing of political influence versus institutional independence. Without decisive action, the lessons of a Fed probe may be learned the hard way, through instability, social disruption, and economic pain. Conclusion: Donald Trump's probe into the Federal Reserve is not just a domestic political maneuver. It is a potential catalyst for global financial upheaval, capable of destabilizing markets, governments, corporations, and societies worldwide. The ripple effects from rising interest rates to currency crises, from geopolitical tension to social unrest, illustrates how deeply interconnected the global economy has become. In this fragile ecosystem, perception and confidence are as critical as capital. And any threat to that perception can unleash consequences far beyond what most people imagine. The story of this potential crisis serves as a stark warning. Institutions designed to protect and stabilize must remain above political interference. The survival of the global financial system depends not only on policies and regulations, but on the collective faith of billions of people and trillions of dollars in assets. When that faith is shaken, even temporarily, the repercussions can last a generation. If you found this analysis insightful, make sure to like and subscribe to stay updated on the hidden forces shaping our world. Future videos will dive deeper into global economics, geopolitical shifts, and the stories that don't make headlines but affect all of us.